Did you notice how banking stocks have been crushing it lately? Way ahead of the Nifty 50? Crazy, right? But here's the twist. This banking surge comes right after the sector faced its worst liquidity crunch in over 15 years. So what went down? At the start of the year, banks were short by a whopping 3.3 lakh crore rupees. Banks need what's called durable liquidity. Basically, enough steady cash in the system so they don't have to scramble for funds daily. The RBI usually wants this at a safe level, around 0.5 to 1.5% of all deposits. But we were way below that. Why so serious? With less cash, banks either had to pay more for every rupee they borrowed or cut back on lending. Both are bad news for growth and make loans expensive for everyone. How did things get so tight? First, December's advance tax payments sucked over 3 lakh crore out of the banks into the government's account. Then, festive season withdrawals, think Diwali New Year, put extra pressure. Add to that, RBI's dollar sales to protect the rupee, which pulled more cash out of the banking system. At the same time, RBI Governor Shaktikanta Das was stepping down, so there was a lot of uncertainty. But before handing over to the new boss, Sanjay Malhotra, Das cut the cash reserve ratio by 50 basis points, down to 4%. This move alone injected a lifeline of liquidity. But the RBI didn't stop there. They went all in. Open market operations, foreign exchange swaps, even variable rate repo auctions, pumping 8.5 lakh crore into the system in just 6 months. With that cash boost, banks could borrow cheaper, lend more, and get back in the game. So it wasn't just luck, it was smart, targeted liquidity moves that sparked the banking comeback. Now, with more cash and a big government dividend, all eyes are on the next big RBI policy meet this June.